Fifth Third is buying Comerica in an all-stack deal that's valued at $10.9 billion. That's a 20% premium to Comerica's 10-day average stock price. After the merger, Fifth Third shareholders will own 73% of the combined company. Joining us right now is Fifth Third CEO Tim Spence and our very own Leslie Picker. First of all, Timothy, welcome. I think two big questions here today. First of all, why Comerica? The second one is why now?
Sure. And I'm Becky. It's now officially you and my mother who use the term Timothy as opposed to Tim. I think why Comerica is relatively simple. The things that have defined Fifth Third over the course of the past 10 years have been this focus on stability, profitability, and our ability to drive organic growth. And in the wake of Silicon Valley's failure, in particular, the strength of the granular retail deposit base that we have. What's defined Comerica is this is an incredible middle market commercial banking platform and the access that Comerica had to high growth markets like Texas and large economies like California, in addition to its legacy presence in Michigan. So the combination of those two things is going to be really powerful. From a Comerica perspective, we're going to be able to take their middle market platform, their specialty verticals, and scale them across our entire footprint. And what Fifth Third will bring to the table is the know-how and the best-in-class de novo branch opening program that has been so successful for us in the Southeast, that we're going to be able to pour it into Texas, where we intend to build 150 additional branches and to move into a top 5 position in Dallas, Houston, and Austin. And I think the rationale for now is these things have to make sense, but the timing has to work as well. So in our case, the Southeast has been a big point of focus for us. We have 85% of the branch locations of the remaining branches we intend to build already secured. So we have the capacity to be looking forward. And from Comerica's perspective, I know it's been a careful and deliberative process that they ultimately concluded, given where they are in terms of asset size, given what they believed they needed to do to continue to build their franchise, that it made sense to be part of a broader company. And that is, from my perspective, a really exciting fit.
I understand why you don't like Timothy. When I'm Rebecca, that means I'm in trouble with my mother. So I get it. And I'll save it for Tim for now. But for the why now, is it also because this is a friendly regulatory environment? Wouldn't have happened before?
Yeah, I have said publicly, I have been pretty confident that we would have had the ability to get a deal done in the prior administration and under prior regulators. We're proud of the strength and stability of the bank. And we were approved to bid on the failed banks in 2023. So the regulators at that point in time were clear that they believed that we had the capacity to run a much larger bank. I do believe that time is your enemy once you announce these transactions. And in an environment where we're seeing merger approvals come through faster, it definitely builds our confidence in our ability to retain the key people in Comerica and the client-facing folks who have such an incredible standard of care with clients, from here to approval and close and then through conversion.
Leslie?
Tim, I wanted to ask you about the diligence process for Comerica. Comerica runs a pretty asset-sensitive balance sheet, historically has had some CRE exposure. What did you find when diligencing their loan book? I know you mentioned on the call that there's some purchase accounting that allows you to rebalance, which could help with some potential volatility. How do you kind of characterize the process that you went through in looking through the loan book, and then also how post-merger things will look for Fifth Third?
Yeah, absolutely. It was a robust diligence process, as you would expect. Our leaders at Fifth Third, one of the things I take pride in is our leaders work. They don't just manage folks. So we had our experts across the organization at the very top of the house, deeply involved in cracking loan files and in reviewing operational processes and board risk reports and otherwise. If you were to look at our balance sheet, so you look at Fifth Third over the course of the past 5 years and say, where have we distinguished ourselves? We're really excellent asset liability managers, right? We came through the SVB crisis in a very strong shape because of the discipline that we have and the way that we manage rate risk. And I think we are the only large bank to be in a net recovery position over the last 3 or 4 years in commercial real estate. So the two areas that you mentioned are things that I would tell you we are unusually good at. Now, the good news, purchase accounting does give us the ability to address the hedges, the rate hedges at Comerica that were causing them to under-earn relative to the natural earning power of the balance sheet. And I think we mentioned on the call that that impact alone was north of $80 million in income in the second quarter for Comerica. The only large bank that I know of that's close to where we are in terms of commercial real estate credit performance is Comerica. And I believe their charge-off rate had been about 10 basis points, which is really excellent in totality. So we remain really comfortable with both those things. In terms of the other things we learned, it is still a disruptive step from 99 billion to 100 billion plus in terms of the regulatory expectations and the heightened standards that were built into the Dodd-Frank Act. And Comerica was having to build out those risk programs on an $85 billion balance sheet, whereas we have those risk programs on a $210 billion balance sheet. So we're very confident in our ability to bring these two companies together and to deliver the same safety and soundness and consistency in terms of performance that have been hallmarks of Fifth Third.